we can't project this or tell down the line.
Right.
The incumbent, what's it called? The recession that everybody has projected coming down the line.
Yeah.
What would be a great strategy for a typical passive investor, since you've already been through the process?
Yeah. So for passive investors, you want to look at number one, what is Wall Street looking at? What are the REITs investing in? Because they're very safe right now. They're very cautious, and they have inside information that the general public doesn't have. So I would look at what they're investing in, and they're investing in the safest asset classes, even at very low cap rates, because they're looking at it as a bond, as a mutual fund, as an annuity. So Class A and B apartments that are stabilized, self-storage in good markets that are occupied, that are fully performing and functional, and mobile home parks. A lot of REITs are moving into mobile home parks in good areas. Now, I'm not talking about the trailer park with the dirt road where everything's falling apart and you got to have the cops out there, and do the drug inspections and things like that. I'm talking about nice paved roads where people live in their good quality, affordable workforce housing. So those are, in any economic event, people need somewhere to live. And if people are losing their homes, they have to move into rentals, whether that's townhouses, apartments, or even single family homes. There are a lot of big developers out there, like the national home builders that do, there's home builders that do 100,000 houses a year, right? That are now building subdivisions for rent, not for sale. So there's a big movement out there to the renter generation. And it really, I did a video on it the other day. Financially, it makes way more sense in today's world to rent versus own if you're paying market value. Now, if you get in and you buy something under market value and you improve it and you build equity, obviously you can make money that way. But if you're paying market value, you're buying a new house and you don't have the ability to pay cash, you have to finance, makes way more sense financially to rent than it does own over a 30-year period. And I did a video on it, and you'll come out with about $800,000 at the end of a 30-year period if you take the money you would have spent just on taxes, insurance, maintenance alone, and passively invest that into another, like a syndication or even mutual funds or something that gives you about a 5% return. Even at a 5% return, $10,000 a year over 30 years will leave you with 800 grand in the bank after you factor in what the cost of owning a house was. If you finance this is a $250,000 house. If you finance a house over 30 years and you pay, 4.5% interest on a 30-year mortgage, you're actually in the whole $250,000 at the end of the year. That's all you will have left over when you trade that house out. So it's pretty interesting to think about it like that.